Today's all about interest rates, the Federal Reserve, and I want $100.
Yes. Right here. Wait. Where'd it go? Just to show I'm coming good. I lost my bet. So just to let you guys know, we bet if the Fed would raise rates or if they would hold. I said they would raise rates in this meeting. You said hold. What you want? Here's $100. Now, we did also talk about this earlier, but I was thinking double or nothing because my original thought was that this may happen, but for sure they're going to raise rates this year.
Yeah. So
I don't know if it's even worth betting, if you feel that too.
Not worth betting, but it's fun. So after the Fed was done, the expectations for the raise again next month, I mean, it's like almost a foregone conclusion right now. But let's summarize for everyone real quick. The Fed came out. They didn't raise rates. But what did they say and do, and what came out in their summary of economic projections? That's the most important part of this. They didn't raise rates, and then Jerome Powell came out in the press conference, and he was a hawk. In my opinion, he talked tough to the market. He higher for longer. He said, we're going to stay here for a while, and just really talked expectations down. The biggest one that I thought was the craziest was the Fed fund rate prediction was 4.6 for 2024. When the board members get together, they vote, and then their votes are recorded, and that comes out in the summary of economic projections. You can see where they're thinking things are going. So we thought interest rates were going to be at 4.6 on the Fed funds rate for 2024. This new summary of economic projections, and this is bad, is now coming in at 5.1. What that means, so everyone is on the same page, that the Fed basically expects no cuts in 2024. And now it shows them not cutting or even starting to come down until 2025. This is a major switch that's happening in the background. So when the Federal Reserve said higher for longer, this is what they meant. And see, the market wasn't listening. Probably the real estate market and the stock market both weren't listening. Both of them are, on a bit of a tear. So the Federal Reserve said, hey, let's make this very clear. Another thing that happened is that PCE, their prediction was 2.6 for 2024, and they don't have it getting till 2% until 2026. This is the first time, once again, in the summary of economic projections, that you see the 2026 number. So they're saying it's going to take us all the way to 2026 for us to get back to the normal rate of inflation. So that means for us, for consumers, for businesses, for real estate investors, you are going to have higher interest rates, 23, higher interest rates, 24, and they'll start cooling in 25 and maybe be slightly below in 26. What are your thoughts? What did you hear as you listened to it? Share with me, because I know you love this stuff too.
Yeah, and to be honest, I didn't watch the whole thing. I was waiting for your recap. But one thing I know from the different patterns over the last 2 years, where Jerome Paul is the most famous economist in the history of mankind, he's like a superstar, he probably loves it, is they talk about raising, stopping, or lowering, but that's not as important as the messaging afterwards. And so the reason I bring this up is you see it in the stock market often. Sometimes they'll say, hey, this is what we're going to do. So they said pause. Not a lot goes on, but then afterwards, and even the following days, kind of shows you the sentiment or kind of the reaction to it. And so you're seeing right now the stock market dropping a ton. It's just all red. Also, this is going to put more fear in people. Yes. And that's one of the things we're talking about today is what's going on with interest rates and how does it affect different people in the real estate industry. So my quick perspective based off of what I did watch and what I'm hearing from you is higher for longer, meaning more expensive for longer too. As if things weren't already expensive enough. And I would dare to say going to get more expensive because, I mean, this gets kind of into the weeds, but, student loans are being repaid again. So people don't have as much money for that. So the economy might not be turning as quickly or as powerfully. So there's going to be less money for things, which trickles to all the other parts of life, including purchasing a home because you don't have as much purchasing
Exactly.
power. And so the last thing to say on the Federal Reserve, this is just me as an amateur looking at it. They're just keeping the gunpowder dry and ready for if there's a crisis.
Bingo.
In addition to fighting inflation, which means they're just being very disciplined and they're being stubborn.
It's like you're at the kitchen sink and, the faucet is going and they didn't change interest rates, but they actually still slowed down things by closing the faucet a little bit with just their words. This morning, the average mortgage went up 41 basis points. So 100 basis points is 1%. So that's 0.41%.
Almost
jump.
0.5%.
Almost 0.5%. It also jumped yesterday. So the NASDAQ took a dive and rates jumped yesterday. This morning, the second they opened, they jumped again. The average person today, par, when I spoke with the lender this morning, I called him first thing this morning, was 7.875. Now, no one gets par, okay? So that means the average mortgage today was in the eights, and it was going to be 1 point to get you to like 7.75 to 7.5. Because par is the rate value, but nobody gets par. You always get par plus like a 0.5 point to a full point.
Do you mind doing some math and showing us an example of what that payment is?
Real simple. For every 1% change in interest rate, you lose 10% of your buying power. So yesterday, with interest rates jumping up over 0.5% overnight, people lost about 5% of their buying power. What that means specifically is if they're looking at like a $700,000 home in our area, they're now looking at a $665,000 home for the exact same payment. That happened just like that. Now, it'll calm down a little bit, but this narrative, this higher for longer, is what we need to be aware of. So the spigot is closing. It's creating a non-neutral rate. It's reducing the liquidity in the market, which makes everything more expensive. There's less money to loan out. It makes student loan debt more expensive. It makes business debt more expensive. Buying a home more expensive. What does this mean for investors? What does this mean for home buyers? I'm going to say it again before this even happened. The winter of 2023 is a phenomenal time to get deals. Even though they're saying higher for longer, if there's fear and less people are buying and we are in a low inventory environment, this is that opportunity for that buyer who may barely qualify because they're not going to have to go fight with everyone. There are some prices that'll probably come down this winter on the buyer side and on the investor side that could benefit that investor or buyer. So you need to start getting your dry powder ready, like you said, and your income and your credit ready and your cash ready so that you can go buy stuff. All this did was make winter even better, okay? Yes, there are some people who are now going to be scared out of the market and completely stop. One of these quotes, so after he's done, right, they start asking questions. And a reporter says, "Hey, we've gone from a narrow path to a soft landing," says the reporter. "Would you call the soft landing the base case?" And if you just watch Jerome Powell's body language, he looks down and he goes, no, I wouldn't do that. That was his exact quote. So as this is tightening up, because they kind of waffle back and forth and the whole media was talking about this soft landing narrative. He said, no, it's plausible, but we're going to have to be in a position very carefully, and we're going to have to be higher for longer. Okay?
He actually said those words, higher for longer.
He said higher for longer. Well, he uses much bigger words. We're going to have to maintain a restrictive rate for a sufficient period of time in order to get the numbers to fall in line. Higher for longer. What that specifically means, though, Jerome Powell does not necessarily believe we're going to get a soft landing. He believes we are headed for some type of a recession. And what we've been kind of seeing is this rolling recession hitting different sectors of the economy coming through. For us as real estate people and real estate investors, what that means is I need you to dig into your local market. You need to figure out your local economy, your local stats, and how this is affecting you. Because inside of this tightening of liquidity is going to create massive opportunity for you to buy. If you are a seller, it's probably not the right time unless you need to or you have to. Now, the spring market's probably going to be on fire again, but I'm just talking this winter. This winter's not going to be that time if I'm just I want to sell to throw it on the market. We're going to run into the have to sells this winter, which means good deals for buyers, good deals for our investors.
Dang. So winter's coming.
Winter's here.
Winter's here. Okay.
Yeah, it's last episode we were talking about winter's coming. Winter's officially here. Jerome Powell talking this tough, and then I went and looked at the Wall Street Journal, CNN, X, all the different news platforms and websites this morning. There is a lot of bearish sentiment out there right now. And then, of course, we had how the stock market responded, and then interest rates went up. What that leads to is it leads to a cool down in the real estate market through this winter, and it naturally does. So it's going to cool down more than normal this winter. Well, when something cools down more than normal, flip it over. That is a buying opportunity for you to get a better deal on price or negotiate phenomenal terms.
The future never exactly happens the way the Fed predicts. There are always unknown factors in the economy that cause them to change their direction. So what's going on here?
This is where, if you listened to the whole asking of questions, Jerome Powell specifically avoided giving a specific answer to this is the thing we're paying attention to. He kept coming back to the totality of the data. Here's what it means. We're driving the car. The headlights are off. We know we're on the freeway. We know the direction we're going in. We can kind of see in front of us. We hope we get there and don't hit anything. By the way, if we hit something, we'll just turn the money printer on. And the Federal Reserve, see, most of us as consumers, we have really short memories. So I went back in time to find an example from the last time they were making a prediction. So the Fed's 2008 forecast, now this was compiled in October of 2007. These were the numbers they were expecting. Spoiler, they are dead wrong. So the Fed could be dead wrong again. GDP growth they were forecasting in October of 2007 for 2008 was between 1.8% to 2.5% growth. The unemployment rate that they were forecasting was between 4.8 to 4.9. We all know what started happening during the Great Recession in 2008. Here's the reality of the numbers that came in. GDP went from a positive number to the reality was a minus 2.5%. Minus. The economy contracted by 2.5%.
They thought it was going to grow from 1.8 to 2.5%, and it contracted
100%. The prediction was unemployment was going to be 4.8, and unemployment came in at 6.9, almost 7%. So the Federal Reserve, yes, they're smart people. Yes, they're brilliant. They don't have a phenomenal track record of getting this right because it's economics. Because there's so many outside factors that influence it. So for you, for me, for our investors, for our listeners, 1, take everything they say with a grain of salt. 2, get ready for deals. 3, if you can't get ready for deals, build your bunker, pay down your debt, save up your cash, and just get prepared anyway. It's bumpy now. It's going to get bumpier. We're headed into the now.
To me, it's not as important what they say is going to happen. It's more important to listen to what they're going to do right now, because that's more immediate and that actually has an effect versus a forecast that's all it is. It's kind of like people predicting the weather.
Yep.
It's like the exact same thing.
Yeah, and none of us really know exactly, what's coming next. And also, we don't talk about this a lot, but the thing to understand, in their predictions are their own personal biases, and also there are probably personal influences that are pushing them to maybe vote or write down a prediction that's one way or another. A lot of times people don't think there's a political side to money. So there may be pressure for one of these Fed members to report something in a certain direction that may not be their actual feeling at that moment. So this could all just be theater to calm the market down, to keep expectations low so that they can continue fighting inflation, because inflation is, as we spoke about last time, go watch the previous episode if you missed it. Inflation is trending in the right direction except for energy, and energy stocks are on a tear right now. If you've been betting on oil, I bet on oil.
Me too.
Oh yeah, buddy.
I got my $100 back from oil.
Oil's been a great bet. So oil's going to get its little run up in this volatility. When the volatility stops, sell off, wait for the next volatility ride, do it again. Not financial advice, okay? This is me gambling with my own money.
Just to summarize real quick, Federal Reserve said that they're going to hold rates, but they plan on making it, keeping it high for longer.
Yep.
If not, highly likely to raise rates to really squash inflation, which inflation is really sticky. Cost of things are really expensive. Secondly, mortgage rates really high, 8% right now.
Yep.
So that affects everybody, but especially buyers. And things are going to get bumpy because it's just too many variables to know. Winter is here. We're seeing it in the industry, real estate industry, and inventory isn't growing, right? It could potentially grow if things slow down, but even then, sellers just want to stay because, again, the lock-in effect where sellers have a low interest rate, 2, 3, 4%. They don't want to sign up for this 8%. So with that being said, what's your advice for investors and developers in this higher for longer interest rate environment?
Everyone always takes this idea of higher for longer and they believe it's negative. Throw your belief out the window. It just is. This is the game that was dealt. This is the game we play. So what you do is as interest rates change, you change your model. You change your method of doing it. So for our investors right now, for our land developers, you need to negotiate hard on price to compensate for these interest rates, number one. Number two, this is the land of terms. So because real estate has stayed so strong, you may not be able to get everything off the price. Price is only half the negotiation. The other half of the negotiation is the terms. Let me explain. If someone owned a building for $1 million and let's say it was worth $900,000, would I pay them $1 million if they gave me an owner finance loan at 3% today?
Right now, yeah.
Let's rock and roll because the traditional market is going to give me a 7%. So don't discount the terms. Now, as an example, in the last 6 months, and we've been talking about this, so if you're subscribed on a regular basis, you've been hearing this, and if you're enjoying this, please hit the like button. You know that we are getting more terms. So in the last 2 weeks, we have put together 4 more deals with terms attached to them. 2 land development pieces right next to each other where 60-day feasibility. At the end of 30 days, we have to give up $1,000. At the end of 60 days, we got to give up $4,000. Then they will give us, for the $4,000, 180 days to get a building permit. And at the end of 180 days, we can give them $45,000 and then they'll owner finance it for a year. So we've built this really long ramp, this really long time horizon that allows us, if necessary, to weather through the market to get to a better market to deliver that product all the way in 2026 if necessary. They also came down on their price a little bit, but the price wasn't as important as the ability to get the terms, because if 2024 is really bumpy and 2025 is really bumpy, I can literally punt this project into 2026 and make money on it then by simply using some earnest money as non-refundable and then some owner financing that creates this safety net and also can create a great future margin. The terms is more important than the price in this example. This is what I need you to get. On the land development side, some of these bigger multifamily guys are getting beat up right now. Multifamily, in the medium-sized multifamily and the large multifamily, is going to be massive opportunity. They're going to have to restructure that debt, which means everyone is going to stop developing multifamily product. And like we've said before, we know we're in a single-family home shortage. Anything that you can build, develop, multifamily, single-family, townhome, manufactured home, teeny house, get it out there. The demand for that is going to be great. We're going to go through a cold winter and everyone's going to get discouraged about the winter. But if you're a true hardcore investor, you're looking for the long run. You're not looking for what's happening this winter. This winter is going to create deals so you can do them next year. I was talking to one of my good friends, mentioned one of the projects that we were working on. He goes, don't sell the house now. Because we're buying the house to build a dadu in the backyard. He goes, just rent it for 6 months. And I look at him and I go, that's not what we usually do. He goes, think about it. Is the spring market going to be better than this fall market? Yes or yes for sellers? I was like, yeah. He goes, cool. So let's just say you lose 10 grand renting it between this winter and next spring. Could you sell the home for 30 grand more in the spring if the normal spring market kicks in? I said, absolutely. That's brilliant. Those are the nuggets we're looking for right now. You have to be patient. You have to create safety, and you've got to create stability. Now, also, most of what you look at is going to suck for cash flow. It's just going to suck, like it's abysmal. So you've got to get better terms. You've got to get owner financing. Or maybe you need to be a little less greedy and just put more money down. Maybe this is the time, instead of having an 80 or a 75% loan to value, you try to get a 60 or a 65% loan to value, and you just get a good investment that does okay today, but you know when interest rates go down, your cash flow is then just going to shoot up at that time. So that's a phenomenal strategy too. Just go secure a good asset. This is not the market to be a speculator. This is not the market to go really wild. Slow, steady, conservative, good base hits, great terms, some cash flow. I'm not saying you're going to get great, and development projects, whether we're talking just single family or not, with long-term terms attached to them so you can weather the storm in the middle if there is one.
Yeah, that's great advice, especially the one about putting more down to kind of hedge yourself a little bit for the unknown variables. Well, these investors, I guess if you have cash, it's not as much of a factor, but most investors probably will get some kind of lending.
Yep.
So 8%, right? Just for beginners, just for starters, it could be higher depending on the terms or whatever. But the question is, what if rates come back down, right? Like, say there is some kind of emergency or some crisis and they bring it down. Wouldn't it make those future opportunities more competitive to your current higher rate situation? But the putting more money down is what protects you a little bit, right?
So the putting more money down protects your downside risk in case, let's say it's a commercial debt. Commercial debt generally has to maintain a certain loan to value. So if the market did drop 10%, you're protected, which protects you at your next refinance. Also, it just protects you because you know you always have equity. We can't always just burr everything and drain everything and every cent out of every project because you saw some TikToker do that. That doesn't work, and it's just not safe, okay? You need to protect yourself. So yeah, maybe we put a little more down. And I love what you're saying, because this is how we want our viewers and our listeners thinking. This is the golden nugget. If the market is slowing down, but it's still good, that's the thing people don't get. Slowing down doesn't mean bad. So the market's still decent. What's going to happen the second interest rates drop? So if the market's doing okay and interest rates are in the 7s, today they're around 8, but they'll go back into the 7s. The second it comes down into the 5s, it's going to light on fire. So if you're like, oh, I want to get a deal, you got to get a deal today. You got to do it this winter. Definitely before the spring, because the thing, when you look at the stats, and you can see this all across the country, is the market comes out of winter and it has this huge spike. And this just happens every year. This is literally the start of the spring market. Oh, hopefully I got it. Okay. February and March, prices nationally just start going like this. So you can always get a deal in the winter. This one's just going to be better than normal.
Awesome. All right, so let's simplify it to maybe the beginner investor or somebody that's looking to build their first house or get into their first investment, flip. And they're going to get a construction loan and then have a final refinance mortgage afterwards. Yep. So obviously this is going to be interest rate sensitive, yep. Especially to somebody who is doing it for the first time. Should they wait if they can wait, or should they get started now, and what are things they want to consider? The
problem with waiting for real estate, especially here in the Seattle metro, is our market appreciates so fast. So the market went up over 7% this year. So if you're thinking about buying your first time home buyer house, and let's just say it's a $700,000 house, Well, that means if the market goes up 7% next year, all of a sudden that'll be a $749,000 house or a $750,000 house. So I want to wait generally costs you a bunch of money in fast appreciating metros. That's the thing to always be aware of. 2, you have to be aware of, is the thing that I'm purchasing as the investor, is it what everyone wants? Or is there a hole in this market where I can get a deal? And in every market, there's always a hole. In 2021, when things were on fire, there were still holes in the market to get deals. So you've got to put in some extra time, some extra energy, identify the market, find the niche that you want to invest in that's going to then create that opportunity. Now I want to flip this over to the land side because you asked a phenomenal question. The question was, if I'm thinking about building a home, should I build a home now and then be prepared to refinance it later? That's a different discussion, but it's phenomenal because I want to work through a little bit of the logic and the emotion that's happening. If you go and build a home for yourself, Benji, is that a logical decision or is that an emotional decision?
I think a little bit of both, but if you don't need the bigger home, then it's emotional.
Maybe a little bit of both for you. For 99% of people, it's all just raw emotion.
Yeah, because, and let's explain that. It's emotion because typically you always get a better deal on new construction with a development or a resale that's just fair market value on the MLS.
Yep.
Because it's almost never going to cost less to build than it is to just buy on the open market.
Because that builder and developer have connections, they know how to do it faster, quicker, cheaper. And lastly, your emotions kick in and you overspend on the budget. And it's not that you can't make equity. I would say the average person building a home for themselves should make around 5%, sometimes as much as 10% in equity when they do it. But what happens is their emotions kick in and then they blow the budget because they had to have this special cabinet and this special countertop and 28 heads in the shower, blah, 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 blah. That's what I've actually seen happen every single time. But let's keep digging into this. So it's an emotional purchase for that buyer to buy that piece of land, correct?
Yes.
And now the Federal Reserve came out and they just talk tough. So the news cycle is tough and the economy is tougher. And we have a presidential election coming. So land sales actually are slowing down right now because that's an emotional purchase. Prices have not gone down, so don't misinterpret what I'm saying. I'm just saying number of transactions and number of offers on vacant land. So that creates your opportunity for you to be able to negotiate on price, to be able to negotiate on terms. Second, if land sales are slowing down and for the consumer, and builders are trying to do it, but they're not quite keeping up, what does that mean for the cost of construction in 2024? Do you think it's going to be up or down?
Down.
It's probably going to be down. That's exactly it. So once again, you kind of got to, and this is so hard, we've got to control our emotions in regards to this because the economy is trying to push us one way. But this is probably the best time in the last 5 years to consider building yourself a home. Competition is down. Construction prices are going to go down. So if you have the opportunity to build something next year, you've got my vote. Go for it. Now, make sure you have additional cash reserves. Make sure we got our 6 months cash reserves. Set a budget and don't blow the budget. Everyone blows it on new construction. Just hold it in. Just rein it in. I'm not going to spend anymore. This is a true story. A new construction project we were involved with because, when they turn into customs, things get crazy. These door hinges were $250 a door hinge. And
how many hinges?
Well, there's 3 per door.
And is it 2-door entrance?
No, these were the interior door hinges.
Oh my gosh.
So 3 per door for every door in the house. And then these special light switches with these special covers. They're almost $500 a piece. What happens is because it's an emotional decision, and this is a true story, they're all of a sudden spending thousands of dollars extra for something that's not going to make a difference. That's what you have to be careful of. That's actually the biggest trap. The second biggest trap is hiring a contractor that doesn't have a long-term reputation, who may just run away with your money, or they file bankruptcy during your project. If the economy is changing and you're considering building, you have to make triple sure that your contractor and the subs that they are choosing are financially solvent to do a construction adventure in an economy like this. That is your biggest problem. Your emotions, and the financial solvency of the main contractor and the subs. My vote is go for it. Like there's not a better time in the last few years. I know it doesn't feel like that, but that's what makes it the good time.
For sure, because other people aren't doing it, which means there's not as much demand, more supply of labor, skilled people, even potentially those $250 hinges, right, might go down in price. Okay, so hey, switching gears, of course, staying on the topic of interest rates, a term I've been hearing on TV a lot from real estate agents is date the rate. Can you explain what that means and what are your thoughts on that, and who is it going to apply to?
Yeah. So real estate agents and mortgage brokers are salespeople, and they're really good at their jobs. And so they come up with ways to describe what's happening. And it's kind of cheesy, a little cringy. This idea of date the rate. Well, date the rate, marry the house. That's the whole statement. What they're saying to you there as the consumer is if it's the right property, fall in love with the house, and that's the one you marry, but just date the rate, and you're going to trade the rate in as soon as rates go down. Because all you have to do is go to the Federal Reserve's website, and you can look at 30-year fixed debt over time, and it's all graphed out for you right there. And if you look at the period over the last 20 years, so just the early 2000s, 2003 to today, 2023, you can see that interest rates in 2003 were about, 6.5, and then they trended down, and then they popped back up, and now they're over that number. It's simple math. If you take interest rates over the last 20 years, they average like 4.5 or 4.75. So can you logically consider that rates should go back down into the fives over the next few years? 100%. So date the rate is this idea is if I can afford the mortgage today, and this is a property I'm in love with, what I'm going to do is I'm going to choke down the high interest rate for a period in time. And then as interest rates come down, I'm going to turn around and refinance. I want to flip this over too. Investors need to be thinking this way too. We just talked about this, 5 minutes ago, is that as an investor, if you can get a quality asset today, and sure, maybe it doesn't have a ton of cash flow, but it has some cash flow. At today's interest rates, that becomes a phenomenal asset when interest rates come back down. So this is a home buyer and an investor dialogue, and almost more important on the investor side, because home buyers are they're wicked geniuses about figuring out how to pay for their house. Once they own it, I've just seen this so much over 20 years. They tell me the payment is almost unaffordable or it's too high. Once they own it, this pride of ownership kicks in, and they just figure out how to pay for it. They figure out how to make the few extra $100, and the payment becomes less important because that pride of ownership, that emotional attachment to it. So I'd almost say it's more important on the investor side because there's no way to make cash flow. You can't raise the rents enough to compensate for the rate. Like as the rate goes down, it's so much more than raising the rents. Your rents will naturally go up at 3% or 5%. If the interest rate drops 2 percentage points, your cash flow went up 20, 30%. So there's no way to balance that one out there.
What do you think? Final thoughts. Date the rate, marry the house. Is it more of a sales technique or is it good advice? If you had to say one or the other.
It's good advice if you can afford the property. And what we're seeing is a lot of consumers be smarter than they were over the last 5 years. Over the last 5 years, what generally happened is if we had a person who said, I want to buy a $750,000 house and I qualify for $950,000, they literally bought a $975,000. Today, they qualify for $950,000 and they are buying the $750,000. I think that's smart. This is the Federal Reserve doing their job. The Federal Reserve, what they're doing is they're getting consumers back in line. They're getting this speculation back in line. They're getting investors back in line. They're getting the cheap money back in line. They're getting Wall Street back in line. They're actually doing their job. You can see it happening. They suck the liquidity out and everyone becomes less crazy. It's no longer the roaring 20s again. Okay? Literally, now that's happened twice. In the 1900s and, now in the 2000s.
Hopefully it doesn't end the same, though.
Yeah.
Great Depression.
I really didn't think about that, and that's a good point. Unchecked capitalism and unchecked loose spending without these guardrails and speculation ends in ruin like that. You may not like it, but it's good the Federal Reserve is doing this. This gets us back in line. And some people, you probably disagree with me. That's fine. Tell me your thoughts. Give me some good thoughts in the comments about, is the Federal Reserve doing this right? Are they doing it too much? Are they doing it too fast, too slow? And what should they be doing about inflation if they're not raising rates like this?
Yeah, the reason I asked if date the rate, marry the house is good advice is because what happens if you do date the rate and you're expecting for interest rates to go down, but it doesn't? Like you said, make sure you can afford the house, but make sure you can afford the payment at that interest rate forever too. Don't completely bank on it going down, because that's similar to a 2008 real estate crash, right? People just thought, oh, I'll take on this variable rate, right? Subprime mortgage or whatever. And then ultimately they couldn't afford it. And that's what's kind of scary about this. I'm not blaming real estate agents, but usually real estate agents are kind of on the forefront, not necessarily you specifically, but they're on the forefront of promoting,
of course,
certain types of mortgages, because part of their business requires some kind of sales going on.
Yep.
So I guess I put that out there because I did hear somebody mentioning it. And ultimately, though you should be working with an agent that you can trust and they know what they're doing, you have to make the decision yourself.
You have to make the decision yourself, and you need to protect yourself by, like you said, can I afford this and do I have reserves? If you don't, you need to stay put where you're at and not move into this. If you have the opportunity to buy that good asset, upgrade that house, and you have the reserves and you can afford it, by all means. Then what happens when interest rates go down? Because they will go down. It's just a question of when. And Jerome Powell just, kicked our ass. So right now it feels like we're, in 2026 before we get some decent rates, which could totally happen. So, plan for 5 years, and if it happens in a year and a half, even better, but be prepared for it to go for 5. History always repeats itself. When we got into the really bad inflation in the 70s, it was around for almost a decade. It took a long time. So it does appear that they're getting inflation under control faster when you look at PCE. Okay. Now, of course, CPI popped up, but the Fed likes PCE better. PCE is trending in the right direction. It's just going to take a while. In the 70s, they did not get it under control. Then they had to Paul Volcker us by jacking interest rates way past the inflation rate. That does not appear to be happening, but still, the American consumer expected this to go away in 12 months, and it's going to go away in 36, 48, 60 months, okay? Not the decade of the 70s, but still some time. So mentally prepare for 5. If it goes away sooner, great. You're still protected.
So higher interest rates for longer. That's the summary.
The summary is threefold. Higher for longer is going to break things in the economy. Be prepared for that to happen. Second, higher for longer means it will create deals for you as the buyer, as the investor, as the land developer. Actually, let's throw in another one. 3, so we're going to 4 now. 3, real estate brokers. It's going to be a bumpy ride, and you got to get in, you got to plug in, you got to work hard. That's just what this is. It's going to take twice the effort and 4 times the amount of appointments to make the same amount of money. And then lastly, you need to do more to protect yourself and speculate less and take less risk. That's what the Federal Reserve is doing. They are de-risking the economy by pulling the liquidity out and keeping the rates higher. That would be the summary of what's happening with rates right now and what we should be doing.
Okay, most important part of this. Are we going to do double or nothing on that?
Okay, so we are down for the double or nothing. I'm going to say pause again on the next. Which one are you taking?
I was going to say they're going to raise rates before the end of the year.
You get next month. That's a shitty bet.
November then.
Okay.
Okay.
So it's double or nothing for November. And my vote is they're paused because I believe we've hit a significantly restrictive amount. However, you and all of the stock market and everyone else is currently betting against me.
Yeah, we'll see. All right, you guys. We'll see you guys next week. Make sure you subscribe for more real estate podcasts, specifically Seattle, but just all around market information.
Thanks for watching today. Hit the like button. Make sure you subscribe. Hey, YouTube recommended you watch this video right here.